Right, so we're still looking at the same question, right? On December 1st, 2021, X Limited paid rent in advance for 3 months, which is 60,000, all right? Then they've been told to record the year-ended adjustment for December 31st, 2021. So in the previous example, we used the liability method, all right, where we're focusing on how much has been earned. But this time we're going to use the income method, where we're going to be focusing on how much hasn't been earned, right? Because remember, we are dealing with prepaid income. Prepaid income is a liability, all right? Whenever our customers, all right, pay us in advance for goods and services that we deliver to them, right? Whenever they pay us money in advance, that money we receive is a liability, okay? Because if something had to happen, then you're going to end up owing your customers the money which they gave you in advance. All right. So we found our monthly charge. It was 20,000. All right. We found out that 20,000 has been earned, and now 40,000 hasn't been earned. All right. So that's what the income method is going to be about. We're focusing on this 40,000 that hasn't been earned. So the journal entries are going to be like this for the income method. All right. I'm going to start on the 1st of December. 1st of December. All right. I'm going to debit cash 60,000. All right. Cash is an asset. An increase in asset is debited. Okay. Then we'll credit rent income. Okay. Income is a revenue, and an increase in revenue is credited. Right? That's for the 1st of December. Now we're going to make the year-ended adjustment. Let's put this properly here. Right, so we're going to make the year-ended adjustment on the 31st of December. Right, 31st of December. Right, we are going to debit the rent income 40,000. All right, remember this is a revenue account. A decrease in revenue is debited. All right, a decrease in revenue is debited, so we debit rent income 40,000. All right, and we're going to credit prepaid income. All right, we're going to credit prepaid income. Right, paid income 40,000. So now let us see how our tier accounts are going to be like. All right, so we debit cash. Hold on. And we credit rent income 60,000. Right. Then remember we're focusing on the amount that hasn't been used. All right. So we're going to debit rent income 40,000, and we're going to credit prepaid income, which is our liability. We're going to credit our liability 40,000. right? So we close our accounts. So let's start with the rent income. This is a revenue account, all right? It's a revenue account. Okay, so we're going to put the highest amount, start 60,000 since 60 is greater than 40,000. All right. So our balance carried down, all right? This represents the amount we have earned, all right? This represents the amount we have earned, all right? And we're going to credit this to the profit and loss account, okay? We'll credit this to the profit or loss account, okay? And our prepaid income, which is our liability, all right, we're going to find it in our balance sheet, all right? This is a liability,